Okay, let's go.
Every day, trillions flow through global futures and currency markets. It is a chaotic, unrelenting environment where fortunes are made and vaporized in hours. Out of this chaos, a very small fraction of traders manage to capture an outsized portion of the wealth. Take Michael Marcus, who steadily compounded an initial $30,000 account into $80 million. Or Bruce Kovner, who achieved a staggering 87% average annual compounded return over a decade, turning a hypothetical $2,000 investment into $1 million. When you see financial returns like that, it is natural to assume these men possess some hidden advantage. You might imagine they rely on complex predictive algorithms, privileged insider information, or an innate economic intuition that the rest of us lack. But the truth contradicts all of those assumptions. Before Marcus and Kovner became undisputed masters of the market, they both made agonizing rookie mistakes. They completely wiped out their trading accounts, suffering devastating financial and emotional collapses. Which raises a strange question. Why do almost all elite, multimillionaire traders have to lose everything before they figure out how to win? To understand the trap they fell into, look at a mechanism called financial leverage. Leverage allows you to control a massive amount of an asset while only putting up a fraction of its total value in cash. In early 1977, Bruce Kovner discovered this mechanic during a tightening soybean market. This chart shows how leverage effortlessly multiplied his initial stake. By using his profits to continually buy more contracts, Kovner turned $3,000 into $45,000 in a matter of weeks. The math worked beautifully in his favor, making the process feel completely effortless. Then hubris set in. On a day of intense market volatility, Kovner's broker called him, frantically screaming that the market was going straight up and urging him to drop his downside protection. Caught in the noise and the panic, Kovner abandoned his original strategy and exposed his entire account to the open market. Within 15 minutes, the market reversed violently. Kovner's account went into an immediate freefall, plummeting to $22,000 in a matter of hours. He narrowly escaped total ruin, spending the next several days physically sick to his stomach from the shock of losing so much money so quickly. Leverage is a psychological magnifier. It mathematically inflates financial profits, but it simultaneously amplifies the human capacity for irrational panic. Michael Marcus experienced his own version of this trap. In 1971, he developed a theory that a devastating agricultural blight would destroy the corn crop. Extremely confident, he borrowed money from his mother and bet his entire net worth on that single idea. This diagram shows a terrifying market scenario known as limit down. In futures markets, daily price drops are restricted by a hard limit. If negative news hits and prices fall to that maximum limit, the buyers completely vanish from the order book. Trading virtually ceases because there is no one left willing to buy the falling asset. When a negative article about the corn blight hit the papers, the market locked limit down. Marcus stood frozen, staring up at the mechanical price board. He was completely paralyzed, watching his net worth evaporate in real time, unable to exit the market because there were no buyers to take his position. Trapped overnight, he had absolutely no choice but to wait for the market to open the next morning. When it did, he liquidated his entire position at a massive loss, wiping out his own savings and the money borrowed from his family. Marcus learned an agonizing lesson. Having a brilliant, perfectly reasoned economic theory is completely useless if fear paralyzes your ability to execute a retreat when the numbers turn against you. These devastating losses forced a shift in perspective. Both men realized the market does not care about their intelligence or their theories. To survive, they needed to completely rewire their psychological approach to risk. Marcus implemented a rigid risk parameter known as the 5% rule. He mandated he would never commit more than 5% of his total capital to any single trading idea, no matter how confident he was. Kovner adopted the discipline of the predefined stop. Before he even enters a trade, he decides the exact price at which he will exit if he is wrong. By placing the exit order in advance, he removes the emotional burden of making a panicked decision in the heat of a market collapse. Both men then had to master the hardest psychological hurdle in trading, fighting the natural human urge to take profits too early and hold on to losing trades for too long out of hope. Achieving elite status in financial markets requires actively suppressing natural human instincts. Success comes from strict adherence to rigid risk parameters, not gut feelings. Today, their methods look entirely different from their early days of desperate forecasting. They no longer try to predict the future. In fact, Kovner frequently buys into an asset without even knowing the fundamental economic reason it is moving. Instead of treating technical chart analysis as a crystal ball to predict where prices will go, Kovner uses it as a thermometer. It simply reads the temperature of the crowd, revealing unusual behavior and alerting him to potential shifts in momentum. Marcus operates with a similar humility. He actively looks for reasons he might be wrong. If a trade feels off, he will exit his position in a matter of minutes, completely devoid of ego, so he can sleep easily and reevaluate the data clearly the next morning. The ultimate truth of the industry is that the market is a chaotic risk environment to be managed. It is not a puzzle that can be perfectly solved. True success does not require a flawless predictive formula. It requires the discipline to define your risk before you begin, the humility to accept frequent small losses, and the resilience to survive your own inevitable failures.